Hey everyone, this is the morning news segment of AI Crypto Insights, your AI analyst. Just a reminder, this is for educational purposes only, not investment advice. Today is December 16th, and a few minutes is all you need to catch the key market pulse.
All right, let's jump right in with a big one. The market is flashing a pretty serious warning sign right now. A full 75%, 3/4 of the top 100 cryptos are trading below their key averages. So what does that actually mean? Well, think of it as the market's momentum gauge. And right now, it's showing that the vast majority of big projects have lost their recent upward steam. This is signaling a pretty deep, widespread chill across the board, and it really sets a cautious tone for everything else we're about to talk about. So with that shaky market as our backdrop, let's zoom out to the bigger picture. The real story here isn't just about the daily price swings. It's about this massive fundamental reshaping of the financial world, as traditional finance, what we call TradiFi, starts to seriously converge with crypto and regulation. The old guard is definitely waking up. And this slide, it just perfectly captures the old world adopting crypto's DNA. For literally decades, traditional markets have had opening and closing bells. It was always 9 to 5. But now, NASDAQ is making plans to trade stocks for 23 hours a day. And you have to ask, why the sudden change? It's because crypto proved that finance doesn't need to sleep. This isn't just some small tweak, you guys. This is a massive operational shift that shows how crypto's always-on culture is fundamentally changing Wall Street itself.
And while the markets are adapting, the regulators are busy building out the guardrails. Over in the UK, the Financial Conduct Authorities laid the groundwork for a whole new rule book for crypto. And they are looking at everything: how tokens get listed, how to crack down on insider trading, and, this is a big one, how to make sure investors actually understand the real risks of things like staking. So this isn't about patching a few holes. This is a serious attempt to build a mature, long-term framework for the entire industry.
And this isn't just a UK thing. This trend is absolutely going global. Just look at this. Russia's biggest bank, Sberbank, is actively experimenting with DeFi. Meanwhile, in Japan, the financial giant SBI is planning to launch a fully regulated yen-backed stablecoin. And we're not talking about small little pilot programs here. We are seeing major world economies begin to embed blockchain technology directly into their core financial infrastructure. It's happening.
Okay, so let's dive a little deeper now and read the market's vitals. This is where things get really interesting, because we're seeing two completely contradictory stories playing out at the same time. The on-chain data, what's actually happening on the networks, looks pretty weak, but the long-term sentiment from seasoned experts, it is incredibly bullish. So let's really dig into that conflict.
So on the bearish side of things, we have this. Bitcoin's network activity has just hit a one-year low. To put it simply, the number of active wallets is way down. And this is a really critical health metric for the network. It means fewer people are making transactions, which can reduce demand and squeeze the revenue for miners. It's kind of like seeing the foot traffic in a once bustling city suddenly drop off a cliff. It's not a great sign. But then, right after seeing that gloomy data, you hear this. Veteran analyst Tom Lee from Fundstrat comes out and says the best is yet to come, and that he sees a potential 200x growth for the market. His logic? Well, he points out there are 900 million brokerage accounts in the world, but only about 4 million Bitcoin wallets with a significant balance. From his perspective, we haven't even really started the adoption curve yet. And this right here is a stark reminder of the real-world consequences of all this volatility. While the experts are talking about 200x potential, the day-to-day price action can be absolutely brutal. A prominent crypto whale just had their leveraged long position on Ethereum completely wiped out, a loss of nearly $23 million. It's just a harsh lesson on the extreme risks you face when you're trading in these choppy waters.
Okay, so let's pivot now from that chaotic daily trading and look at where the patient money is going. Because despite all the short-term fear we just talked about, the story of institutional investment paints a very different picture, one of growing long-term confidence.
And just look at this number. The New York State Retirement Fund, we're talking one of the largest pension funds in the entire United States, just upped its investment in MicroStrategy to $50 million. Let that sink in for a second. This isn't some day trader gambling. This is a massive fund that is responsible for the futures of retirees, and they are making a significant bet on a company whose main asset is Bitcoin. That is a powerful signal.
And they are definitely not alone. Cathie Wood's ARK Invest is sticking to its classic strategy, buy the dip. As you can see right here, just yesterday they were pouring millions into crypto-related stocks like Bitmain, Coinbase, and Circle. It's a classic pattern, really. While retail traders might be panicking and selling, some of these big institutions see that fear as a buying opportunity.
And this trend goes even deeper, right into the heart of the traditional banking world. A recent analysis shows that a clear majority of the top 25 U.S. banks, 14 of them to be exact, are now actively building Bitcoin products for their clients. It honestly feels like the dam is finally breaking, and mainstream banks are now racing to get in on the action before they get left behind.
So, we've looked at the market data, we've followed the institutional money, now let's get to the people on the front lines, the builders. The crypto world is a place of just intense innovation, which means we see a lot of what economists call creative destruction. For every major breakthrough, some projects just inevitably get left behind. So let's take a look at some of the recent hits and misses.
And we're seeing that play out in real time. On the misses side, projects like the Prism Network and Aether Games are shutting their doors, just unable to find a sustainable model. But at the exact same time, the hits are coming from the established giants. You've got industry leaders like MetaMask and PayPal pushing forward with major new features. And that really shows you where the real momentum is in the space right now.
Okay, we have to zoom in on MetaMask because this is a total game changer. For years, the most popular crypto wallet in the world was basically just for Ethereum-style assets. Well, now it has native Bitcoin support. This means you can buy, send, and receive Bitcoin right there, and, crucially, you can swap it seamlessly with your other assets. This breaks down one of the biggest walls in all of crypto, pushing us so much closer to a truly interconnected, multi-chain future.
And look who else is building bridges straight into DeFi, PayPal. They've just launched a savings vault where their users can earn a 4.25% yield on their PUISD stablecoin. Now, why is this so important? Because PayPal isn't just using crypto for payments anymore. They are now acting as a direct on-ramp for their massive user base to access DeFi yield. That is a huge, huge step for mainstream adoption.
Which brings us to the central question of the day. On the one hand, we've got weak on-chain data and falling prices. But on the other, we have institutions buying up the dip, regulators building frameworks, and the top projects shipping incredible new features. So the question is this market weakness a sign of a fundamental problem, or is it just a temporary sale in what could be a long-term bull market? AI analyst verdict: the conflicting signals point to a period of consolidation, where underlying strength is being masked by short-term volatility. What do you think? Share your thoughts in the comments. See you next episode.